Somehow I have some trouble here. So welcome back, everybody, to another webinar organized by Princeton University's Bentham Center for Finance, hosted from Princeton for everyone worldwide. We're very happy to have Jay Powell with us, the chairman of the Federal Reserve Bank and the governors of the Federal Reserve. Hi, Jay, good to have you.
Good to be here.
Thanks a lot. It's great to have you. Jay is actually an undergraduate from Princeton University and also was part of the advisory council at the Bentham Center for Finance here at Princeton. So we're very grateful that he spent some time with us today and enlightens us on the new Fed policy. I have a quick overview of the topics we would like to cover today. We would like to talk about this new flexible average inflation targeting. We'll talk about deflation and inflation traps, and then about financial dominance, macroprudential policy, a little bit of fiscal dominance given the high public debt levels. And then we will contrast the COVID crisis with the global financial crisis of 2008, talk about central bank independence, the swap lines, and perhaps also about exit strategies later on. So with this, let me start with the new flexible average inflation targeting, which came out of the review process the Fed went into. And I was wondering whether we can specify a little bit more the framework. What does flexible mean? Where the average inflation, over what time period one takes the average? What's the rationale behind it? Is it about how sticky prices and wages are? How long will they be sticky? Is this driving the average? or is it the maturity of the debt contracts? What's the average maturity of debt contracts that drives how long we take over what period we take the average? And then it's about inflation measures as well, because now with the COVID crisis, the consumption basket is shifting a lot over the time period. How do we take this into account? So going to a restaurant, having a healthy meal is infinitely expensive, but just going to a restaurant and eating is probably not so expensive. So how do you measure inflation this way? And there are many, many challenges, and perhaps you can elaborate a little bit on this new framework, which I think is very exciting. We would like to learn, the audience would like to learn more about it. So Jay, can you elaborate a little bit on?
Sure, I'll be glad to.
Thanks a lot.
First, Marcus, thank you so much for inviting me here today, and thanks for these webcasts. I've listened to a number of them, and I've found them very interesting and thought-provoking. And I'll be very honored to join your wall of guests with my photograph if you'll put it up after this. So thank you. So on our new monetary policy framework, as you will know, as your listeners will know, we're a dual mandate central bank, and our statutory goals are maximum employment and stable prices. And over the course of 2019, 2020, we engaged in a review of our strategy for achieving those goals. And it was our first ever public review of this nature. And we conducted it in a highly transparent way that involved significant public interaction with the constituencies we serve. I would point in particular to the Fed Listens events that we held around the country, meeting with members of the general public, with a particular focus on low and moderate income communities, labor unions, small businesses, and the like. So the point of the exercise was to step back about a decade after the global financial crisis and ask, what have we learned about the conduct of monetary policy? Specifically, due to a number of persistent factors that are global in nature, interest rates are substantially lower, even in good times. In the US, we've been at or fairly close to the effective lower bound most of the time for a decade. In other jurisdictions, Japan and the EU, rates are even lower. And this has highly important implications for the conduct of monetary policy. The flexible inflation targeting framework of the past couple of decades was successful, but it needed to be adapted in a systematic way to the new normal of life close to the lower bound for interest rates. And that's really the essence of it. So last August, we announced the results, which involved significant changes to our strategy for achieving both of our goals. Again, maximum employment and price stability. So Marcus, your questions really went more to the price stability side of the mandate. So let me start with that. In essence, the committee, the FOMC, reaffirmed our understanding of price stability as achieving 2% annual inflation over time as measured by the PCE price index. But we added several new important ideas. We stressed the importance of having inflation expectations well anchored at 2%. Which of course enhances our ability to achieve both parts of the mandate. And the centrality of inflation expectations, I think, is a theme that will come back again and again in the discussions. We said that to achieve inflation expectations well anchored at 2%, we actually need to achieve inflation that averages 2% over time. Thus, we said in order to achieve inflation that averages 2% over time, following periods when inflation has run persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. So that was the sort of logical flow of that. Now we've called it a flexible average inflation targeting regime. And your first question is, what do you mean by flexible? In effect, that's the question. So the first thing it means is that we haven't tied ourselves and won't to a particular mathematical formula when we aim to achieve inflation moderately above 2% for some time. So policy will continue to reflect a broad array of considerations. There's always an element of risk management. There's always an element of judgment. We want inflation expectations, though, to be well anchored at 2%. And again, you need to average 2% inflation over time to achieve that. As you know, we use policy rules and formulas in our models, and we consult them often in our work, but we don't set policy by them. The second reason we say flexible is just that we're a dual mandate bank, and we'll always consider both parts of the mandate. And that means we couldn't really tie policy to a formula that applies to only one side, in this case, inflation. I'd also be remiss if I didn't briefly mention the equally important changes we made to the employment side of the mandate. So I'll just mention a couple. We added new language saying that maximum employment is a broad and inclusive goal, which reflects our appreciation for the benefits of a strong labor market for many in low and moderate income communities. Second, on the employment mandate, we say that we will react now only to shortfalls from maximum employment, as opposed to the old language, which was deviations from maximum employment. And that reflects our view that employment can run at or above our real-time estimates of its maximum level without causing concern, unless accompanied by signs of an unwanted increase in inflation or other risks that could impede the achievement of our goals. An important change. And that clearly follows from the experience of recent cycles, especially the last few years before the pandemic, in which labor market conditions were very strong indeed, yet inflation was quiescent. And we saw the substantial social benefits that a strong labor market can and did bring. You also, you pointed out in your question, I believe, that the benefits will be more fully realized to the extent it's seen as credible, the new framework. And I would say a couple things there. First, since we announced the framework in August, there's plenty of evidence that market participants have shifted their expectations in ways that are consistent with the new framework. Surveys now show that market participants expect us not to raise rates until inflation has reached 2% and until the labor market is very strong indeed. And that is also consistent with our rate guidance. But I would say our eyes are wide open on this. At the end of the day, the public will need to see us allow inflation to move moderately above 2% for a time before the new framework will be seen as fully credible.
Thanks a lot, Jay. So if I may just follow up on this, so did you move away a little bit from a single number like NIRO or R star, that you said it's a single R star this way, so you can predict perfectly a single R star, so it becomes more flexible in this regard as well?
I'm sorry, I didn't catch your question.
Did you move away from the NIRO, the non-accelerating inflation rate of unemployment? Is it more flexible in this regard as well, as there's not a very strict framework, but a more general, flexible way of thinking about it?
Yeah, that's clearly the case. So we will continue to write down our own estimates of NAIRU, of the natural rate of unemployment. Of course, that's only one factor we take into account when we talk about maximum employment. One of the big lessons of the last crisis was how much room there was in labor force participation, which performed really quite differently than expectations and better. So we're really looking at employment to population and the size of the workforce and things like that, as we always have, broader things. So we'll always write down estimates of the natural rate of unemployment. What we're really saying, though, is we're no longer going to raise interest rates just because, for example, if unemployment were to be well below our current estimates of the natural rate of unemployment, that wouldn't be a reason to raise interest rates unless we see troubling inflation or other imbalances that could threaten the achievement of our mandate. And that's a significant change. If you read the transcripts that were released of 2015, there was a lot of discussion of the issue around, could we let unemployment go below the natural rate? We saw what happened. I mean, we were the first group on the committee to see a sustained period of very low unemployment in many years. And we saw that it didn't produce troubling inflation, and we very much took that on board.
And by doing so, you take indirectly some inequality considerations into account as well. If the labor market works well, it helps the less well-off more. Is this a consideration as well, the inequality inclusiveness component? Yes,
the sense of our looking at maximum employment as a broad and inclusive goal does include that. And you'll notice that we have been talking more and more about various kinds of inequality that have been sustained and have grown in our economy over the years. And there's a reason for that. And that is that we think they connect directly to our maximum employment goal. So maximum employment, if you take that statutory goal seriously, it isn't achieved if there are lots of people not working around the edges of the labor market who could be working, who constitute potential labor force. And there's a lot of that in minority communities, low and moderate income communities. So we focus on it, and we never really did just look at the aggregate data, at least in recent years, but we will continue to talk about those longer running features of the economy and we'll continue to take them into consideration in looking at maximum employment. I should add, though, that we do understand that those issues are important national issues that require a society-wide effort, and that's business, that's fiscal policy, that's the Fed, and what we can do, we will do, and it's important, but really the main answers have to come from education and training, and it has to become a national goal, I think, and we're hopeful that that will be the case.
Okay, so let me move on a little bit to the inflation dynamics, because there's of course a danger we might end up like in Japan, that there's huge right now in the crisis, there's this huge deflationary pressure because, forced saving by individuals. But on the other hand, there might also be a pent-up demand, and there might be inflation whipsaw, you might go back. So we might end up, in a situation where we have to be very aggressive, put the foot on the accelerator, but then we might get stuck in a low inflation environment for quite a while, or we might also end up in the other extreme and pent-up demand kicks in, and then inflation will come back up. So what do you think are the essential elements to control this whipsaw mechanics, which might occur or might not occur, or we might just get stuck in a low inflation environment? What do you see? How does the new framework help us in this to manage this better, or help you to manage it better for our economy?
Yeah, so a couple of things I would say about that. First, as you suggested, in the near term, as the pandemic recedes and we see potentially a strong wave of spending as people return to their normal lives and begin consuming various services, there could be quite exuberant spending, and we could see some upward pressure on prices. And by the way, at about the same time, we'll be seeing measured inflation go up because of base effects as we lap the low readings of the first of March and April of last year. So in fact, that's quite possible. Indeed, that is in the forecast of many economists. But the real question is, how large is that effect going to be, and will it be persistent? So, because clearly a one-time increase in prices that isn't very large is very unlikely to mean persistently high inflation. And that just is a function of the underlying inflation dynamics of the U.S. economy as they have been in the last many years. As you know, we have a flat Phillips curve, meaning there's still a small connection, but you need a microscope to find it between slack in the labor market and inflation. We've also got low persistence of inflation, so that if inflation were to go up for any reason, it doesn't follow, inflation doesn't stay up. And that it used to be, if you go back to when I was an undergrad at Princeton, you had a steep Phillips curve, and it was combined with highly persistent inflation. And that's what gave you the inflation that I graduated into in 1975 and later in that decade. So dynamics will change, but they don't change. We don't think they change, quickly or on a dime, and we'll come back to that. I also think, let's say that does happen. Let's say we have a strong economy in the second half of the year, and that continues. Remember, we're a long way from maximum employment. There's plenty of slack in the labor market. Unlikely that wage pressures are going to be reaching a level that would support higher inflation. Also, second, the other factor I'd point to is look around the world. Shortage of demand in lots of large advanced economy countries around the world who began this crisis at deeply negative interest rates and have had little policy space with interest rates. Now, there are other things they can do, and they are doing, but that all is going to hang around for a while. And the U.S. economy is strongly integrated with the rest of the world, and that's going to matter. I should add, of course, if inflation were to move up in ways that are unwelcome, we have the tools for that, and we'll use them. We will use them. No one should doubt that. That's in a way too low inflation is the much more difficult problem to solve. I'll stop there. We can talk about it more.
So let me move on perhaps to the next topic, from price stability to financial stability, which is also a major concern, I guess, for you and the Fed more generally. There's also this concept out there of financial dominance. So if the financial sector, of course, is very sound at this point, but there might be over leveraging going on also on the corporate side. Do you see that there's some threat from financial instability which might limit what monetary policy you can undertake at some point down the road? And do you think the macro-prudential tools the US has are sufficient to avoid such a financial dominance circumstances? And finally, one of your bond purchasing programs, which helps very much the corporate sector to come over the crisis, some corporations might use it to lever up and pay out dividends, higher dividends, or buy back shares. Is there any ways of modification that you say, or only firms which issue bonds and that don't pay dividends or higher dividends than before can be part of this bond purchasing program? So is there any tools like macro-prudential tools you can invent, or is there other tools compared to other countries you would like to have compared to other countries?
You know, so I would say we don't feel any pressure from financial dominance. So we'll talk about fiscal dominance, I suppose, in a moment. But if financial dominance is the reluctance of or even inability of the central bank to tighten policy because of the leverage in the private sector, we simply don't feel that. Our corporate sector, our non-financial corporate sector, did go into this downturn with relatively high leverage, but at these low interest rates, the interest payments are actually not at a terribly high level by historical standards. They're sort of at a normal level. We have not seen the big uptick in defaults that we thought we might see in non-financial corporates. We really haven't seen it. So it's just not something we are feeling or have ever felt, really. We will, when the time comes to raise interest rates, we'll certainly do that. And that time, by the way, is no time soon. You ask about macro-prud tools. So the difference in the United States between the United States and other countries, I would say, is that we do not have a lot of time-varying tools that are where we can see a particular situation and go in after that situation. And the history of those, we've had them over history, and it hasn't been a good history. It's very difficult to get the timing right and that sort of thing. What we do have is strong through the cycle tools. So the idea is we're not going to rely on our ability to put these things in effect at the right time and in the right proportion. We don't think we're very good at that. We think it's better to, as one of our mutual friends and colleagues likes to say, better to build strong levees than try to predict hurricanes. So what we've done is particularly in good times, we run these very strong stress tests that require banks to be resilient against the kinds of massive stresses that can suddenly appear in the global financial crisis, in the aftermath of the arrival of the pandemic. And I think that's the right way to do it. And those are always on, good times and bad. You want to be building the strength of the financial system during good times and holding on to those gains. And that's really how we look at it. We're not really seeking the other kinds of tools. Other countries have a different political economy, and that's the way we're doing it. And I think that way works. I think if you look at the performance of the U.S. banking system, certainly, and many aspects of the non-banking financial sector, which we can talk about, they performed fairly well so far during this episode. You mentioned the bond purchase program. So we had a primary facility, and it closed on December 31, but where we were willing to lend money directly to companies. And then we had, really as a way to get a grip on financial conditions in the non-financial corporate market at the height of the crisis, during the really acute period, was a secondary market one where we would buy very, very small amounts of bonds for issued by like 800 different issuers. And the idea was we wanted to be able to, if conditions started to fall apart, get in there and have a strong effect. We didn't extend any new credit to any corporate in either program. We didn't make a single loan, as you probably know, in the primary one. And we're just buying a handful of loose bonds in the market for 800 different issuers. So we weren't really in a position to demand that anybody do anything. The other thing, though, I would say is that's a decision for Congress. We really shy away from anything to do with credit allocation. And there are all sorts of sort of social benefit and cost judgments that can be embedded in the kinds of factors. Those are great judgments. They're important judgments, but we're really not comfortable making them at the Federal Reserve. We don't want to get into credit allocation based on a lot of different factors. That's what elected people are elected to do. There are all sorts of places in the federal government where they're providing credit to important constituencies and industries at attractive rates, and that's the job of elected people. So that's how we think about that one.
Great. So let's move on and go a little bit deeper into the COVID crisis. And I think what's striking is to contrast it with the 2008 global financial crisis. Where do you see the major differences between the two crises? And would you say that the COVID fundamental shock was way larger than the 2008 shock, but that the reaction of the Fed was also much faster and perhaps prevented some amplification, which would have observed otherwise? And are there any lessons from 2008 which are very useful this time around, and other lessons which were outdated or irrelevant? Is there any contrast you can make between various forms of lessons of 2008?
Interesting. So you're right that the COVID shock, just strictly as a matter of the arithmetic of the decline in the first and second quarters, the COVID shock was significantly larger. But really, the two episodes are just fundamentally different, and the most important differences are not really about size. So if you go back to the global financial crisis and the Great Recession, they resulted from the buildup of unsustainable imbalances in the economy in the form of a housing bubble that popped. And then an undercapitalized banking system amplified that shock rather than absorbing it. And that system ultimately needed to be bailed out by the taxpayers. There were also lots of points of failure in the non-bank part of the financial system as well. And going into the crisis, household indebtedness was quite high, a lot of it in the form of completely unsupportable mortgages. So when the housing bubble popped, the housing sector was buried in debt and foreclosures came in, and you were in right away in a very, very slow and painful and long recovery. Very different situation here. The pandemic was effectively a natural disaster, right? And it struck an economy that was performing well. Now, every economy, and certainly our economy, faces plenty of longer run challenges. But I would say there were no obvious imbalances that threatened the long ongoing expansion. You really can't identify something that looked like, if this blows up, it could blow up the expansion. The banking sector, as I mentioned, was much better capitalized, had much more liquidity, a far greater appreciation of its risks thanks to stress testing and such. We did see some problems this time in the non-bank sector of the financial sector, but less so than in the GFC. Households were in relatively good shape going in too after many years of deleveraging. Corporate leverage was high, as I mentioned, but we haven't seen really the payoff there in a negative way. So there's another, and you pointed to this, another critical difference is this time, both fiscal and monetary authorities responded very quickly and very powerfully and in a sustained way. Critically, it was sustained. And I would just say this was a particular shock that called for fiscal policy. What we can do is we can restore market function and sustain market function, and then we can stimulate aggregate demand with highly accommodative monetary policy. This situation with 25, 30 million people out of work overnight effectively called for fiscal policy more than, and we got it, in the form of the CARES Act, very, very large and very, very quickly. There's no close precedent at all since the Depression for what happened. And both reactions were swift and overpowering. So that was a big difference. And I think we did learn that. We learned come in early and come in hard and don't leave till the job is done. The last thing I'll say, other difference is just completely different, is the primacy of healthcare policy. The single most important economic policy in this is healthcare policy. It's two things. It's getting control of the spread of the virus, which we have not been able to do with much success yet. But it's also developing, medical innovations for treatment and ultimately vaccination. So many, many differences, but I would say we did apply some of the lessons of the global financial crisis.
But would you say if we didn't have the 2008 crisis, your response would have been different? Or there were some lessons from 2008 which helped you to make a quick response and all that? Or exposed some good out. The 2008 was good to have this experience from 2008 for this crisis.
It's hard to say that I wouldn't want to get caught saying that 2008 was a good thing, but nonetheless, I would just say it this way. I think, and I joined the Fed in 2012, so I was there for the response. We still had a long way to go in the economy, and of course, I'm very familiar with what happened during the crisis. And yes, we learned plenty of lessons. You know, the whole review, effectively, if you look, you can take a step back. In 2012, we didn't know whether the new normal, what it was going to be. For many years, people were writing down, I was writing down a return to 3% growth, a return to 4% nominal federal funds rate. I mean, and a 10-year yielding 4 or 5%. We didn't know. So we lived through a 10-year, 128-month expansion. And we see what's happening around the world and happening in the US economy. We see the performance of inflation. We learned. We also learned from, I would say in particular, fiscal policy tightened a lot in 2000, I want to say 13, 14, and 15. And, so the Fed is over there doing QE3, and the maturity extension program, I guess, was a little earlier. And fiscal policy is just a weight on the back of monetary policy. It's not helping. There was a response at the beginning, but it ended too quickly and it wasn't sustained. So we didn't, not only did everyone act, fiscal and monetary act, quickly and strongly at the beginning, but we've seen follow-up from the fiscal authorities. And I think that's been part of the story. And I think you're looking at forecasts now where we're potentially back to the prior level of output, the pre-pandemic level of output relatively soon. And the key thing there is maybe we'll be able to avoid a lot of the damage to people's lives, what we call labor market scarring. But what it really amounts to is people losing the life they've made in the workforce. And that's really the thing that we're most focused on is getting back to a strong labor market quickly enough that people's lives can get back to where they want to be. Because we were in a good place in February of 2020, and we think we can get back there, I would say, much sooner than we had feared.
Good. It's always we have to end at a positive note in the webinar series. That's our tradition. But before we do this, perhaps we can look in various crisis tools the Fed has employed during the COVID crisis, and the Fed has assumed the various roles. One was, I think, very crucially in March, the Fed intervened, or you intervened, in order to stabilize the system, not only for the US, but for the global economy more broadly. And one was that the US Treasury, 10-year US Treasury, the market making function was not working so well anymore. And you took on the role of the market maker of last resort. That's something which I think one has to elaborate on a little bit, and to what extent the Fed is also there in order to ensure that the safe asset status, that the US Treasury remains a global safe asset, what role the Fed plays in this regard. What I found most striking, essentially, and you alluded to this already, is that the Fed put up the corporate bond programs and also for Moody's, and it was enough to just be there as a backstop, and the market was then working on its own again. So without really buying corporate bonds, it worked already phenomenally well again, and there's a record issuance of corporate bonds in 2020. And despite that the Fed only said, with communication, we will step and backstop if something were to go wrong really dramatically. And on top of it, perhaps you can allude a little bit about the difference between being on the financial markets, but also helping out also small and medium enterprises, SMEs, through Main Street facilities and all this. What was your experience on that? How well does this work also in conjunction with the US Treasury? And then another dimension was essentially becoming the lender of last resort at a global scale and establishing the dollar as a prominent global currency. And there's some argument out there that the swap lines were very, very crucial at that point. And actually, it's a good deal for the US to have the swap lines, but because essentially you become a lender of last resort to many, many banks across the globe. But the default risk essentially is taken on by the national central bank in wherever this headquartered, the other private bank is headquartered. And I think that's, perhaps you can allude a little bit the role of the swap lines, how important it is, and how much it actually establishes the dollar as a leading currency in the world. And finally, How do you see the fiscal $1,200 which was spent up? Was this a fiscal helicopter drop, using Milton Friedman's term? And now we are talking more about another $2,000. Do you see this as a helicopter drop of money in a monetary sense? Of course, it's done always by the fiscal side. So, and how do you take the interplay into account?
So those are some topics, very good ones. Let me start with the treasuries. So, of course, everything we do has to tie into our mandates, which are maximum employment, price stability, financial stability. And I would say restoring a critical market, such as the treasury market, to functioning. The treasury market is so central to all markets. That clearly ties into our role. And I'd say what we did is we bought. We weren't making a market. We were buying a lot of treasuries and MBS, and I mean a lot. So, and I would add, though, that the performance of the treasury market and the mortgage market in the acute phase of the crisis does suggest that we need to think about market structure and greater resiliency. I know you had Daryl Duffy a while back here to talk about some of that, and of course we're doing that. One of the main things we're doing is we're looking at the role of regulation and market structure in the treasury market, because we really need the treasury market to work. It bestows vast goods, a vast good on the public. In terms of a safe asset guarantor, we don't have a formal role at that, but if we do our job well, then we will foster the creation of safe assets, and also foster the use of the dollar as a reserve currency. They're not direct goals, but nonetheless, they are things that certainly benefit the United States, and to the extent they are well aligned with the achievement of our goals. So I think that will happen. In terms of the backstop effect was extraordinary. You may remember Hank Paulson, I think it was, saying in the last global financial crisis, "Give me a bazooka, so I won't have to use it." Well, then it didn't actually work that time, and maybe the bazooka wasn't big enough, but it really did work this time. And it was effectively, one way to think about it is just the elimination of bad tail risk. So as soon as we learned this quickly, as soon as we announced the facilities, these facilities take much more time than you would imagine, or than I had imagined, to set up. They're legal structures. There's just a lot of work that goes in, and we're so lucky that we had a lot of the people at the Fed and some at Treasury who had worked on these facilities in the last crisis. And you know all of them, Marcus, but great people who are, don't get a lot of public recognition, but I mean, when the bad situation is there and they're on deck, they are serving this country really well. So a lot of gratitude for them. In any case, what happened was, this time we would announce this facility, the corporate facility or the muni facility, and the market would start working right away. So ironically, the fact that there was low take-up, actually no take-up for the corporate and low take-up for munis, was nothing but a sign of success. The amount of borrowing and the level of interest rates that's taking place in the muni markets is extraordinary. It's setting all kinds of records, and rates are low. This is true across the credit spectrum. So effectively, the backstops really, really work. You pointed out Main Street. So it is just much more difficult to reach non-financial businesses, small non-financial businesses that don't have bond market access. It's very, very difficult for the Fed because we have no experience in doing that. And by the way, we're a bank regulator, and we've spent the last decade, working hard with banks not to make bad loans. And so I think one of the things we learned is, it's particularly for these smaller firms, and what they really needed in many cases was the PPP program, or some kind of a transfer to keep them open. Fiscal policy, they need fiscal support. So the answer for a small business that really can't operate is not necessarily to borrow. And many of them took the view that they'd rather not borrow, and because you got to pay that back. Whereas PPP was effectively a transfer program, as you know. Anyway, I think a lot of work will be done on should the need arise again to reach non-financial corporates on a mass scale. I think we do need to spend some time in the next year or so thinking carefully about what the best way to do that is. On the swap lines, so dollar funding markets around the world benefit U.S. households and businesses substantially. And the reason is that they amount to lending that winds up showing up in consumer lending or business lending here in the United States. In addition, they're very important markets, and when they experience significant stress, that stress tends to show up quickly in U.S. markets, particularly short-term markets. So they're very important in the world, and our swap lines again did a good job, I think, of keeping those markets working and really serving the U.S. economy as well as the global economy. So I think there's a lot of gratitude, and this comes with being the global reserve currency and a good economic citizen of the world. But it really helps people in the United States a lot as well. It's not something we give to the world. Treasury repo facility is, I think you're talking about the FEMA facility. So this is new. This is for countries that are not large enough or otherwise don't qualify for a swap line. It's just a place where they can turn their treasuries into cash. A big part of the risk-off event at the beginning of the acute phase of the crisis was selling by sovereign owners of treasuries in quantity, and that there just wasn't the capacity to handle it in the private markets. And so a treasury repo facility would have taken up a lot of that, and it was an important factor. On the fiscal helicopter drop, I'm gonna take a bit of a dodge on that, if I may. That's straight fiscal policy. You can argue the need for that for countries that are sort of in a permanent liquidity trap, but that's not the United States. We have policy space. We'll have policy space for interest rates again fairly soon. I mean, in the sweep of history, it'll take a few years, but so I'll take a pass on that one if I could.
Okay, so let's now move. The public debt level, of course, has reached record heights, and actually, if you look at the CBO forecast, it's going up tremendously over the next few years. And the question is, how will this impact monetary policy? Perhaps you can allude a little bit on that. And of course, the overall interest burden, we had some webinars by Chris Sims and Jason Furman saying, okay, that's not such a big problem as long as the interest rate stays low, the real interest rate stays low, one can handle a higher debt level, but it is nevertheless might be constraining through fiscal dominance monetary policy down the road. And how important you see is the independence of the central bank, of the Fed, that at that time when it has to step on the brakes a little bit, that it can actually raise interest rates. Do you think it's very, very important? And do you think it's very important not only for the Fed, but for other central banks around the globe as well? So, and how would you stress the importance of the independence of the central bank? Also in connections with the 13.3, whether there's some things you think it's ideally solved institutionally in the US, or do you think there's other modifications we need, some modifications or not? And finally, I would like to, in times of crisis, one says, typically the treasuries and the central bank should collaborate much more closely. And you did so with US Treasury, also with the corporate bond buying purchasing programs, which I was talked about, where essentially the tail risk was taken on by the US Treasury rather than by the Fed, because that's not the role of the Fed. Any lessons we should learn from this interaction between the treasuries or the finance ministries and the central banks, not only for the US, but also for other countries?
Okay, so to start with public debt and monetary policy. So I just would say, first of all, the US is not on a sustainable path at the federal government level in the simple sense that the debt is growing substantially faster than the economy, and that means by definition it's unsustainable. That's not to say that the level of debt is unsustainable, and it's not unsustainable. It's far from unsustainable. And so I think we're a long, long way from fiscal dominance in the United States if we ever get to that place. And it certainly is not a factor that we consider in any way at this time. So high public debt in no way impacts monetary policy now. We are squarely focused on serving the public through our new framework to achieve maximum employment and stable prices. My strong view is that central bank independence is an institutional arrangement that has served the public well. And I think, every advanced economy, democracy around the world has central bank independence. Institutional arrangements differ, but I do believe it has served the public well. I frankly think that is well understood among elected representatives, and I think on both sides of the aisle, people do understand that that having an independent central bank really does help, particularly in times of crisis, but also just through the business cycle where you can really be focused on serving all of the American people and ignore political considerations completely. 13.3 is I'll talk a little about 13.3 and collaboration. So what that does is it allows us to do emergency lending. It's been on the books for a long time, and the tests are unusual and exigent circumstances. Borrowers can't get loans. Effectively, it's an emergency, and the private sector intermediation has broken down or isn't working to the point where the rates that are being charged are just not in the range of normal. So that's when 13.3 comes into effect. We use the 13.3 quite aggressively and to good effect during the financial crisis. Dodd-Frank took the position and made it the law that if you're going to do that kind of emergency intervention in the markets, then you really should have participation and approval from elected governments in the form of the executive branch, and that means the Treasury. So every facility that we set up under Section 13.3 requires the approval of the Treasury Secretary. I would say I think that's good policy. I think that's appropriate, and I would. It's also the law. So that's what we did, and you'll make your own judgment. People will make their own judgments, and we'll study it. But my own sense is that that our collaboration with the Treasury was very successful throughout this, and it really did work. And there was a lot of benefit too, because the Treasury has they have sole responsibility for fiscal policy. It's the Treasury who we're not in the negotiations, and we don't want to be in the negotiations over fiscal policy. We speak to fiscal policy at a high level. And try not to get into the details, and we're not, we don't want to be in the details, but Treasury is in those. And so for Treasury also to be part of 13.3, I think it helps Treasury have a strong perspective. And I think the whole system works. And the other thing I'll say is, as I mentioned, there are people at the Fed and at Treasury who have this institutional knowledge. The relationship is a good one. I think finance ministries and central banks around the world do know one another well. We stay in our lanes. We have different authorities, different responsibilities. We respect that, and we stay in our lanes, and they stay in their lanes. So I think it does work. I think our current institutional arrangements that we have are quite workable, and so I wouldn't be looking to change them. Did I get everything on this page?
Yes. Just if I may throw in on the public debt, Jason Furman was mentioning that the US is in a very comfortable situation with this high debt level because everybody else is going into high debt level as well. So on the global scale, it might be more challenging for other countries. And he used the term, you only need to be the least ugly horse in a sense in terms of high debt levels in order to be able to fund yourself at a cheaper rate. But it might be more challenging for other countries, more challenging.
We haven't. You had Jason, Larry Summers, Olivier Blanchard, others have been looking at this question. We haven't really incorporated the low interest rate environment into thinking about fiscal policy. And so this is, and the sense of the work of all three of them is that if you look at real interest payments as a percent of GDP as opposed to debt as a percentage of GDP, you see a much less concerning picture. Now, this is new work, it's new thinking, and there's no doubt there's something in it. It's not something I think that has made its way into the policy debates yet, but it is interesting.
Cool. So let me go to the next. So let's suppose, hopefully the crisis will be behind us soon with the new vaccines coming out, and at some point we have to start thinking about exit. And I know that some of your colleagues, I think, or even you said it's too early to even think about exit. But perhaps at some point we have to start thinking about exit. And I was wondering, are there any lessons from taper tantrums, or certain things we should avoid, because taper tantrum was very detrimental, primarily for other economies outside of the US. What are the lessons we could learn from the past experience on taper tantrum? What not to do, what to do? And we touched already on financial inclusion and inequality when we talked about the unemployment. But I was wondering, other tendencies, other future developments are the central bank digital currencies, digital Fed coins and aspects like this. Is there anything which is urgent, or do you think right now we focus on the crisis and the COVID crisis, and once this is settled, one can focus on central bank digital currencies and other aspects? I know that one thinking is that other smaller countries should move ahead with CBDC and experiment, because you don't want to risk the global world currency, the US dollar, with new experiments on central bank digital currencies. Let smaller countries experiment, and then depending what their experience is, the US dollar can move further. So as a global planner would act this way, because you don't experiment essentially with the global currency. I don't know what your thinkings are on these various topics.
Okay.
Exit and perhaps other future projects which are not so urgent at this point.
Let me start by agreeing that now is not the time to be talking about exit. I think that is another lesson of the global financial crisis is be careful not to exit too early. And by the way, try not to talk about exit all the time if you're not, if you're sending that signal, because the markets are listening. The economy is far from our goals. And as I mentioned a couple times, we're strongly committed to our framework and to using our monetary policy tools until the job is well and truly done. And I think the taper tantrum, as you asked about the taper tantrum, it highlights, I think, the real sensitivity that markets can have about the path of asset purchases. We know we need to be very careful in communicating about asset purchases, and I'll come back to that in a second. A couple of general caveats is we always try to avoid an excessive focus on a particular likely path, the most likely or modal path for the economy, because monetary policy is only sometimes about the most likely path. It's often about how do you conduct risk management to avoid, downside cases. So that's a little bit why our guidance on both rates and asset purchases is not time-based. It's outcome-based. It requires the achievement of various objectives, and those objectives will come when they come, rather than when one might mark a calendar. You really can't do that in advance. But we will, of course, be very, very transparent as this comes, as we get close. So I would just say this on the current situation: when it does become appropriate for the committee to discuss, specific dates, and that will be when we have clear evidence that we're making progress toward our goals, and that we're on track to make substantial further progress toward our goals. When that happens, and we can see that clearly, we'll let the world know. We will communicate very clearly to the public, and we'll do so, by the way, well in advance of active consideration of beginning a gradual taper of asset purchases. So that's how we're thinking about that. Let's say something about CBDC. So we don't have an explicit plan to do what you articulated, but since we are the world's reserve currency, we actually think we need to get this right, and we don't feel an urge or need to be first. We have effectively, it means we already have a first mover advantage because we're the reserve currency. So, and I think there are both benefits and potential costs and unresolved questions around CBDC. And so we're committed to, technology has made this possible, and it's effectively private sector actors can create the equivalent of digital money. We know that in the past, when private sector money, the public sometimes just thinks of it as money, and then at some point they find out that it's not money, and that's a really bad thing we need to avoid. So we're going to look at it very, very carefully. We're investing heavily in understanding the technology and analyzing the policy questions, the many policy questions that come. We will also do, as we go through this process, we'll do a great deal of outreach to every constituency that would be interested, including elected representatives, including financial sector participants, including, as we did with the monetary policy review, the people we serve, to try to understand what are the use cases, do we need this, how would it help, what are the benefits, and I think all of that will inform our thinking as we go through it. So I think we're determined to do this right rather than quickly, and it will take some time. I think it'll take measured in years rather than months. But I would say, since it's possible and private sector is already kind of doing it, I think this is something we need to take very, very seriously.
But to make sure that private sector is moving ahead, not spilling over and creating some risks for the Fed to have to step in ex post, I guess.
Yes, there's a need for, and we've been very focused, as you know, on better regulatory answers for potential global stablecoins in particular. So that's been a high level focus, and that will continue to be a high level focus because they could become systemically important overnight, and we don't begin to have our arms around the potential risks and how to manage those risks, and the public will expect that we do and has every right to expect that. So that's something that we've been working on with our colleagues around the world, and that will go on as well. It's a very high priority. So
let me conclude with another group of questions which are more for the academics in our audience. So would you advise us, economists, academic economists, what would you advise us to work on? What are the most urgent needs? And what research do you find very useful? And your interaction during this Fed Listens program, you also interact with academics and non-academics, but any advice you have to the group of academics who work on research on monetary policy, monetary economics, and you see now a very fruitful environment doing this, given that you provided so many natural experiments to the academic community during the crisis periods?
Yeah, so I'm not a research economist, but it's fair to say I'm an avid consumer of economic research, and it's hard for me to imagine a time that would be throwing up more situations that call for deep research, natural experiments of various kinds. It's just an extraordinary time. And so I'll just mention a few, in the maybe near and middle and then longer term. In the near term, of course, a very high priority for us is understanding what actually happened. And, you don't know that until you really take it apart piece by piece. And that's what actually happened during the acute phase of the crisis. And then the things that we did, how did they really work? The parts that didn't work so well, why didn't they work? All of that will be gold. And I think a lot of effort will be spent on that. I think more medium term, we want to understand the extent of labor market scarring and damage to the productive capacity of the economy. That's obviously a key thing that we're monitoring very carefully, and any research around what we did. And there different countries did different things with their labor markets, and the question will be what worked and why. And they're different things. There's our economy, our labor market has traditionally been more adaptive, more flexible, and this will be a different economy when we come out of the pandemic. And so how will that work? Longer term, of course, I would point to climate change and the implications of climate change for the financial sector, for the economy. We're at the early stages still. I see you have Bill Nordhaus coming soon, but we're still at a very early stage of trying to understand what the implications are for the economy and the financial sector in particular, and hence how do we incorporate those into our policies, particularly supervisory regulatory policy, as we try to manage that risk on behalf of the public. So those are a few things. I mean, there are just so many things. I'm sure I'm leaving many out, but I think it's got to be a very rich environment.
Thanks a lot. So actually next week, Jim Stock will also talk about climate change. And of course, climate change is challenging because you have to project out 50 years. That's a huge forecasting challenge as well. So thanks a lot. I think this was fantastic. I think I learned a lot. And I think we really appreciate your time for being with us and really illuminating us about the thinking, what's going on within the Fed. And typically we have the tradition in this webinar series that we end at a positive note. So you have to give us some positive outlook or some positive perspective, what you have experienced in the last 10 months, or something where you look forward, saying we're looking beyond the crisis, what will help us in the long run, and what are the positive aspects. Of course, there are a lot of negative aspects, but let's switch it off for now and just focus on the positive things. And perhaps you can give us 1 or 2 sentences on some positive note.
I think that's easy. I remember coming back to the United States from an overseas trip in near the end of February, really being concerned about the possibility of very, very horrible outcomes in the economy and in society. And it just, so we went to work, and Congress went to work, and the people who invent vaccines went to work. If you sitting here on January 14th of 2021, we are not living that downside case. I mean, I'll always remember the discussions we had, which were pretty scary in March and April. And, we were doing the best we could. But here we are now with vaccines, the population's getting vaccinated. And, you're in a situation where we could be back to the old economic peak fairly soon and passing it. And we may bypass a lot of the damage that we were concerned about to low and moderate income people who, by the way, still have very high unemployment. But with the reopening of the service economy later this year, we hope we'll get back after that. So I would say I'm optimistic about the economy over the next couple of years. I really am. We've got to get through this very difficult period this winter with the spread of COVID. But as the vaccines go out and we get COVID under control, there's a lot of reason to be optimistic about the U.S. economy.
Thanks a lot, Jay. It was fantastic to have you with us. But I thank you even more for saving not only the U.S. economy, but the whole global economy in March, April 2020. I think I'm convinced without the action of the Fed, we would live in a totally different world these days. And the decisive moves were very, very critical. And deep gratitude for doing that. Thanks again, and hope we stay in touch.
Thank you. And remember, we're a team of great people. We're not, we're a lot of people who are